Welcome to The Explainer. Today we're diving into a massive financial strategy, one that's been quietly fueling global markets for decades. But the source material we're analyzing suggests the gears are grinding to a halt, and the fallout from it unwinding could be absolutely explosive. So let's just start with a number, okay? Just to wrap our heads around this. $20 trillion. That's the estimated size of a single type of trade that has basically been the bedrock for global stocks, bonds, you name it, for a whole generation.
So the source material we're looking at today asks a pretty terrifying question. Is this massive trade about to blow up? And if it does, it suggests the fallout could send everything, from stocks and crypto to even supposedly safe government bonds, crashing down hard.
All right, so let's dig into this $20 trillion threat that's been kind of hiding in plain sight. Okay, so what is it? Well, it's called the yen carry trade. And for decades, it's basically worked like a free money machine for global investors, all thanks to Japan's really unique economic situation. So how exactly does this quote-unquote free money machine even work? Let's break it down. It's actually a beautifully simple four-step process. See, investors borrow Japanese yen for almost nothing, literally near zero interest. Then they swap it for US dollars and buy assets that pay a much higher return. Think US tech stocks or Treasury bonds, and they just pocket the difference. That's the whole game. And look, this isn't some new thing, right? It's been a powerful engine for global finance ever since Japan's economy just hit a wall back in the 1990s. Its central bank made borrowing yen dirt cheap to try and fix things. But now, after 30 years of this, that engine is seriously sputtering. So here's the million-dollar question, or maybe the $20 trillion question. Why now? Why is this incredibly stable, decades-old trade suddenly at risk of a total collapse?
Well, the analysis points to two huge problems that are flipping the entire equation on its head. First, the cost to borrow in Japan is suddenly rising. And second, the Japanese yen itself, the currency at the heart of this trade, is actually getting stronger.
And this slide, wow, it really lays it all out, doesn't it? The difference between then and now. What used to be a no-brainer is turning into a massive liability. Funding costs are jumping up, and because the yen is getting stronger, investors need way more dollars just to pay back their original loans. The free money party, it's over.
And to make things even more complicated, this is all happening while Japan's own economy is hitting a rough patch. Its GDP recently shrank for the first time in 6 quarters, and that puts a ton of pressure on its central bank to change the very policies that made this carry trade possible in the first place.
And this chart? It shows you exactly where the pressure is coming from inside Japan. You've got inflation that's been high for years, but Japanese workers' wages just haven't kept up. That stagnation crushes consumer spending, and it forces the government and the central bank to do something, which just further disrupts the whole carry trade. So, okay, it's a problem for Japan, but how does that become our problem? How does this turn into a global issue? Well, the analysis warns of a domino effect, a meltdown that might start in Tokyo, but definitely doesn't end there. This is where things get really dangerous. It creates this vicious cycle, right? As these loans become unprofitable, banks start making margin calls, and that forces investors to sell the very assets they bought with the borrowed money just to cover their losses. This forced selling creates a pretty predictable chain reaction. It's like pulling the thread that unravels everything. It starts at the riskiest end of the spectrum with things like crypto, but then it cascades through gold, stocks, emerging markets, and eventually it could even hit the massive US Treasury market.
And the end result of all that selling is what's described as a liquidity vacuum. Seriously, just picture a giant drain opening up in the middle of the market. All that selling sucks money out, leaving fewer and fewer buyers. This can cause volatility to absolutely spike and trigger what's called a major dollar short squeeze. Basically, a frantic global rush to buy dollars that pushes its value sky high. Okay, so given this potential storm brewing on the horizon, what does the source suggest you could actually do to prepare for something like this?
Now, super important disclaimer here. These are just potential strategies from the source material. This is absolutely not financial advice. But the suggestions include things like maybe taking some profits on tech stocks, moving into more defensive areas, and holding US dollars so you have firepower for potential buying opportunities. And it's not just about your investment portfolio. On a personal level, the suggestion is to go back to basics. Beef up your emergency fund, take a really hard look at your spending, and get your budget locked down tight. The whole idea is to build a financial buffer to weather a downturn.
and maybe even be in a strong position to take advantage of it.
So when you put it all together, the source presents a compelling and, yeah, pretty alarming case for the end of an era. And it leaves us with one last, big, provocative thought to chew on. What really happens to the entire global financial system when an engine that's been running nonstop for 30 years just shuts down?